Hi, welcome to Market in a Minute. Congratulations to the Knicks. I didn't think they were going to beat the Spurs, but I was rooting for them. So great job. I loved the Knicks when I was a kid. I really liked Walt Frazier. I thought he was a great player. Now we think oil prices are going to come down even more than what they have. So we think they may retrace down to the lows of where they were, maybe even lower, and that'll pressure inflation to come down as well. And it probably will set off a cycle of rotation that we saw early in the year, but rotation back into these economically sensitive stocks. So Walsh speaks on Wednesday. This should be really interesting. The bond market is expecting two rate increases. We don't think that's going to happen. And looking out to 2027, we see a tsunami coming of lockups. So we saw a tsunami back in the year 2000, all the lockups hitting the markets then, and we think we might see something similar. So we need to be thinking about this. Disclosures, please read those at your convenience. Market update. So there's two major things that we've been concerned about. One's been the high price of oil, moving itself through the inflationary cycle, making inflation more of a permanent thing, prices having to go up, and the Iran war was taking too long. We thought that Trump really needed to pull the trigger. By God, he did. And he got his deal. So that's great. The second big issue has been the weighting in technology. So the tech sector, when we checked last week, we didn't check this week, but it was roughly 50%. And now with SpaceX going in, at some point in time in the S&P 500, likely in a year, that's even going to add more to the weighting in tech and tech related. So that's going to become an issue for the markets at some point as we see those lockups hit. So what happened? Trump got his deal. The market reacted positively. That's great. And then the markets recovered, roughly 5% off the bottom. So the markets came down in a big way. We think partly was because of the inflationary issues that were lingering, and partly because of people liquidating securities to buy SpaceX. So come Monday, what we saw was the opposite reaction was, okay, everybody didn't get what they wanted. SpaceX continued to go up as it's going into some of the indexes. And again, we have the Nasdaq coming in a couple weeks as well. That should be a big push up in SpaceX stock. So what's going on is people are buying back the stocks they likely sold a week ago in anticipation of this IPO. So we see more tech IPOs coming, and we're going to go over that in some detail in the next couple of slides. But it's creating this massive bubble in the technology space, how big it is. So it has fundamentals, but it's a cyclical thing, and it's just a massive bubble that's occurred in the markets, and it's going to have to correct itself at some point in time. So here's the price of oil. And so it got well above $100 at one point. Back in May, it was roughly 106 or so, and now it's roughly $80. We think that the price of oil for the month of July may be down 20%. And then maybe it's headed to the 200-day moving average about 73. And then ultimately, as they rebuild the inventories and people got used to pumping more oil because it's profitable, you just can't shut off right away. We think it's maybe coming down to that $55 level or lower, kind of where the bottom was last year. So that should provide a really nice backdrop for the economy. So as oil prices come down, we think it's going to allow the economically sensitive stocks to perform, interest rates to come down, pressure off the more sensitive areas of the economy, and the consumers that were dependent upon buying with a large part of their income gasoline and other energy are going to really benefit from this, and those companies that sell to them are going to benefit, and those people that sell things that are interest rate sensitive, like building materials, I think are going to benefit in a big way as well. So we might see this big cyclical pickup as we go through the year and into 2027. What's important this week is what the Federal Reserve Chairman Walsh, the new Chairman Walsh, what he says about the outlook for interest rates, inflation, how is he going to deal with the balance sheet, which is something he'd like to reduce. So the bond market is currently, this is the 2-year Treasury. The 2-year Treasury is 0.5%, 50 basis points above the federal funds rate. So the 2-year Treasury generally leads what the Federal Reserve does. And the bond market is saying to the Federal Reserve, we think you should raise rates by 0.5%. So I like to see what Walsh says about this. If he puts any sort of color on it at this point in time, positive or negative, is going to move the markets. So we think that this will likely not happen, this increase in federal funds rate. You generally don't raise rates on a supply shock. The supply shock appears to be coming to an end. So we think that that 2-year Treasury and the entire yield curve will probably drop now as the war in Iran is basically getting resolved. Tsunami of lockups coming in 2027. So this is something to keep in mind. This is not going to bite us right now, but it could in 2027. And I just want to show you, this is a long-term chart of IPOs. So the yellow line is the actual dollar amount of the IPOs, and the blue line is the number of IPOs. So the most recent peak that we had was in 2021. The IPOs got over 1,000. To be exact, there were 1,078 IPOs in 2021, about 300 billion of IPOs, and it just destroyed a lot of the markets. So we had a lot of tech, 426 technology stocks, 332 healthcare stocks. The healthcare stocks are still trying to recover from this. The XBI, which is a good measure of the biotechnology sector, it's still trying to recover. Still is not even close to being back to its old high. And if you go back to the year 2000, we had roughly 84 billion in IPOs in the year of 2000. And you put that in today's dollars, that's $160 billion of IPOs. So it's expected that this year we're going to do about $250 billion of IPOs. Who knows? Might be a lot more than that. The top 4 companies, tech companies, are coming public. We just got SpaceX. We got 3 more big ones coming. That's going to amount to, just on those 4 companies, about $4 trillion of market value that will have to be unlocked and available for sale in 2027. Now, I know if I own one of these companies in an early round, made a lot of money in it, first thing I would do is I'd realize my profit when I could. So when that lockup occurs, usually it's at least 6 months out. Sometimes it's 12 months out, depends on the terms that they crafted during the IPO. But so sometime in 2027, we're going to see a lot of these lockups hit the markets. This is unusually large. This is extremely high level of lockups. So it's not just the number of IPOs that were done, it's the amount of money that's going to hit the tape in terms of people selling their lockup securities. So we have a lot of money on the sidelines. There's $7.9 trillion of money market funds. That's a lot of money. So that's roughly 10% cash available to buy IPOs or to buy whatever there is to buy, these lockup stocks. However, we don't think that this money is going to get unfrozen, basically, come out of the money market funds unless interest rates are a lot lower. So at this point, we need rates a lot lower to offset this tsunami of what's coming in 2027. So maybe it occurs, and I don't see a way really around this unless rates are a lot lower as we go through 2027. So I think our guess is that this much money that will be unlocked will be just too much for the overall markets. So it's not something that we should panic about now. As the market gets oversold, take advantage of it. But it will become a problem in 2027. So our tactical moves from last week, boy, we had to move fast. When that Trump news hit, we had to cover our shorts right away. We were defensively positioned. The stock market for that last week and the week before were really acting horribly, and obviously some of that was selling to buy SpaceX, and then some of that was people getting concerned about this Iran war not getting resolved. So when that news hit on the Trump saying the Iran deal was done, we quickly covered our short positions in our strategies that were net short, or not net short, but were hedging. And we took that money and then we bought the SPI with it. So we had to move very quickly. The S&P 500 itself came down to right around the 50-day moving average. Remember, 50 days, something that we like to use as a really good indicator. So it came down and it bounced. Now the SPI, which is a high yielding version of the S&P 500 using options, okay, it got down here below the 200-day. And then we bought this with the proceeds from our hedging and some accounts, some strategies a bit more. So we actually got really a lot more invested than what we were. So basically we were on the offensive when that news hit. So what I like about the SPI, I think this is a beautifully crafted ETF. Kicks off 11.5% dividend yield, pays monthly, and tracks the S&P 500 fairly well. It's not one for one, but it's fairly well. So we like that a lot, thinking that, okay, if the market moves sideways, we're going to pick up 11.5% yield. If the market moves up, we're going to get some appreciation plus 11.5% yield. So we thought that was a really good opportunity for us to step into and completely change the dynamics of how we were positioned, and we had to. So, thank goodness the market didn't continue to go down. So the theme that we've had, right, is that when oil prices come down, interest rates are going to come down because inflation expectations will come down, and those companies that are exposed to this sort of benefit should do fairly well. As I mentioned, it started to work it early in the year. Now it's starting to kick in again. We saw some of this start to work. Carnival Cruise Lines, very dependent upon their costs needed to, and profitability because of it, but their costs to run those ships because of the energy they need to buy. Lowe's is obviously very interest rate sensitive. As rates come down, there's going to be more housing turnover, and these guys will benefit greatly. Stock's nicely cheap, and it's come off the bottom some. Capital One, COF, I think this is an extraordinary value. I think it's way, way undervalued. It's like 8 times earnings and high quality company. Things are going really well at Capital One. Their consumers are a little bit, sensitive to oil prices and interest rates. So this was a beautiful pickup for us at these levels. I really like it at these levels. I think it has a long way to go. And then Wendy's, okay? Wendy's, this is interesting. So it's had this major move down in price. Its stock was over $20. It got down below, $7, and it popped. This is a few weeks ago. It popped because an activist said, we want to acquire this company and are looking at financing the acquisition of Wendy's. So it had this nice move up, from under 7 to over 8. And then Wendy's customers, they're really dependent upon gasoline prices like all restaurants are. That's the incremental dollars is eaten up because of gasoline. So now that hopefully that money will start to flow back into the restaurants. we think that Wendy's looks really attractive. It's pulled back again, and we think it could have a nice pop. It's got an 8.3% dividend yield. The restaurants appear to be on the really early stages of turning, and they have this big growth strategy they're kicking off in China. So this is not one that's going to be a huge mover over time, but we think there's 50% upside in the stock, plus we get a 8% dividend yield. So we like Wendy's. So just keep in mind that we are probably in the early stages of seeing this rotation. Technology, it's got the heat, right? There's the market wants to own tech, and probably it's going to continue to do reasonably well as we go through the year, but we're going to see some rotation to take some dollars away from it, particularly as we see more IPOs in the tech space. And then we're concerned about all this tech selling from these newly created companies come in 2027. So right now, I think this is a good opportunity to make some money in the markets, and we want to be positioned correctly. We want to be somewhat defensive about it. So we're buying good companies at attractive valuations, and really happy we bought the SPI, really attractively priced the day we did. So take care, and if you need anything, please ping me, Patrick Adams, CFA, or come over to my website where I work, PVG Asset Management. Thanks a lot.